Welcome everyone to this Friday webinar. In the rhythm of Friday webinars, today we have Sandip from ICICI Alternatives. Sandip, is a fund manager with one of their AIFs and is heading their quant-based fund management. Quant is something which has been kind of rising across the entire fund management industry, be it mutual funds or PMSs. We have seen some of the quant funds have actually delivered far better returns than human-based fund managers, and these quant funds are actually unbiased. And why and how they can add value to investor portfolio from here onwards, when markets are actually entering into the unknown, I would say, territory, because all of us understand that markets are high, but markets are kind of not taking a breather and may not take a breather, or if take a breather, there is so much liquidity which is like chasing and wanting to enter to the markets. And exactly this is what we are wanting to understand through webinars these days, because at these levels, what is right for our clients is something that we are also wanting to understand from various fund managers when we do some of these differentiated webinars. And this is also one such differentiated webinar whereby we are wanting to understand that what is it that various companies like ICICI AMC is a very large AMC, what is it that they are trying to do at these levels, if they are trying to create a product which is something which is trying to address the real problem at these levels. And that is the overall context of this webinar. Welcome Sandip to this Friday webinar. Your presentation is already live, and I'll just play that for you. You have full 1 hour for this webinar. The topic for this webinar, as we discussed a week ago, is unlock the power of quant and fundamental expertise. Best of luck to you. You can take first half, say 30 minutes, to present this, and then we'll take Q&A.
Thanks, Kamal, and thank you for giving us this opportunity, and thank everyone who have joined on the call. As Kamal highlighted, we have seen the trends in the investment landscape, specifically global markets. If you see, the use of quant have increased substantially over last few decades. Obviously, that trend is visible in the domestic markets also. In India also, if you see the use of quant models, the use of factor, the use of technology in the investment world is increasing substantially. Interestingly, what we have tried observing is that individually both quant have their positives and negatives. Same is the case with individual driven funds. If you see, they have both positive sides and negative side, and that's the reason if you do combination of both, we believe it can actually give much better experience for the investors over a long period of time. And that's the reason if you see, the name of the topic today is Quanti-FI, which is actually using the power of quant with the fundamental expertise. So actually we are trying to combine both the worlds. We are trying to use quant in a investment world which is driven by individuals, and that's where we see combination of both can play out in a very big way. Hope I can change the slide. Is it changing? Kamal, if you can confirm.
Yes, absolutely. Perfect.
Yeah. Thanks. So as Kamal highlighted, just to give you a brief on the AUM which we are managing as a AMC, we are managing approximately around 5,83,000 crore of AUM on equity mutual fund side. We are managing approximately around 31,000 crore of AUM on alternate side. In this also, if you see the split of the alternate AUM which we are managing, in that also we have around 27,500 crore of AUM in long only strategy. This month we have crossed 30,000 crore in this. Private capital is approximately 2,700 crore on hedge fund category, long short and enhanced dynamic equity fund which we have. Both put together is approximately 1,000 crore of AUM. So on alternate side also, the number of products which we have across categories, we are trying to increase the range on that, but obviously on equity side we are managing approximately 28,000 crore of AUM as on 31st of July. This is very large AUM, both put together, equity, mutual funds and alternate space. If you see, we are one of the large AMC in the country. To manage this AUM, we have one of the largest in the industry research capabilities. Internally, we are covering around 600 companies today, and the mid and small cap universe is approximately 480. So that way, the number of companies which we are covering internally is very wide, and to cover these companies, we have got around 30-member research team. Apart from this common research team, which is catering to both mutual fund and alternate vertical, we have separate fund management team. The fund management team on the alternate side is headed by Anand Shah, who had been into the markets for more than 2 decades. And apart from Anand Shah, we have Chokalingam, who had got more than almost 2 decades of experience. He had into equity markets. Gitika Gupta, myself, and Manocha also have a very long experience into equity markets. So the point is, we have very large investment team. We have I would say, fund management team, which is catering to both the verticals separately. The point today is the challenge, I would say, in the investment landscape today is the availability of data. And I would say it is not only challenge, but it is opportunity also if you can utilize that well. The availability of data is in a way increased substantially. The sources of information, if you go back 20 years, 30 years, hardly you used to get information on any company. You had to actually wait for annual reports to get some sense what is happening in the company. But today, if you see on every minute basis, you are getting updates on various different companies. And internally, as I said, we are covering around 600 companies. So availability of data on these companies have in a way increased substantially. And the speed at which you are getting this data is also one of the challenges. Now, how you can use this data and convert this data into information. So apart from companies, obviously you are getting data on macroeconomic parameters also, like how currency is moving, how crude oil prices are moving, how interest rates are moving. All of that is very, very important in the decision making. So how you can use this data, how you can convert this data into information, and how you can use this information into your decision making, and that too without any biases, because ultimately the good investment decisions are taken when they are taken without any biases, right? So facts are your friend, and emotional decisions taken with in investment world actually are your enemy. So that's where we believe you have to differentiate the noise with the information, and you have to actually use that information in your investment decision journey. And that's where I think both are very important. At the speed we can execute this decision making, and with what accuracy you can do that. And if you can do that, obviously it can be a very large differentiating factor as a AMC also. If you can create these efficiencies, then probably you can deliver a much better return experience to your investors. So that's the challenge, but that's the opportunity also. How we are doing this, and internally what we have done over a few year period, we have tried to build a lot of models. And models actually are a very strong guiding factor for us in our investment decision making. So various different models we have tried to create: asset allocation model, sector model, market cap model. These models actually give lot of signals, and they are actually very less biased. So they process all the informations which we are getting every day, every minute. They process that information, they give the output, and broadly that output is a guiding factor. And for a lot of fund, it is a guiding factor. For a lot of fund, it is a deciding factor. So that way, these models are very, very strong, integral part of our investment decision making internally. And in that same journey, what we have done, we have tried to create model based on factors. So it is a factor-based framework which we have tried to create to identify company. So this model we have tried to create on alternate side. So on PMS and AIF, we have tried to create this model, and we are trying to use this model to identify companies. So we'll try to give you more details, what parameters, what data we are looking when we are trying to identify these companies, but we have a very well defined investment philosophy. So we'll start with that and then probably move on the model side. But what we are looking for, it's very clear. If you are very clear that what you want, then probably you can build the model to identify the companies. And what we want is very clear, the investment philosophy. And I'm sure this philosophy had been discussed on various different forums, including this platform. We are trying to invest into companies based on 3 parameters, trying to identify companies based on 3 parameters. The first parameter is business. Aim is to invest into companies which are growing faster than the sectors, and sectors which are expected to do well compared to the overall economy. So that's the first parameter. But that can ensure you have superior growth rate. But for sustainable growth rate, the businesses have to have some sort of moat, some sort of differentiating factor. that can ensure that growth is not only for 1 year, 2 years, but it can sustain for longer period of time. So that's the first parameter which we are looking for, which is business. The second is management, and corporate governance standard is very, very important. But apart from that, the capital allocation is something which we are very, very focused on. So that's the second parameter in terms of management. And third is valuation. And valuation is third because our aim is not to create cheap value companies portfolio. Our focus is more on growth. Our focus is more on competency of management. But the valuation has to be reasonable. If you pay very high premium to buy even a good quality company, then probably you have to wait to make some kind of return. So this is what we are looking for: business, management, and valuation. To identify these companies, we have tried to create a model which is based on factors, and there are 5 factors which we are using, and obviously there are many factors which we use as a second signal. But the 5-factor model: first is low volatility, second is quality, third is valuation, fourth is earning, and the fifth one is price performance. So these are 5 factors which we are using to identify companies. The ultimate goal is to get companies which can fit into business management and valuation framework. So moving on, what is factors? Right? So if we start with very, very basic, what is factor? So factor actually is nothing but it's a common thread, a common characteristics which you'll find in the company, and the very common factors which is used in our country, and which is actually in a way had become very, very popular in the country over a long period of time. The first one is value and the second one is growth, right? So value and growth are very common factors. If you see a value portfolio, you'll find the common characteristics, which is valuation. If you see a growth oriented portfolio, you'll see the companies which are there in the growth portfolio actually have a higher growth compared to the overall market. So these are the 2 common factors which have become in a way very popular in our country in last few decades. But if you create a portfolio which is based on single factors, you will find that there are a lot of periods when these factors go through outperformance and underperformance. Like if you see this period of 2017 to 2019, now this was a period when quality as a factor was doing very well. So and value was going through a pain period. So you can see quality in this 3-year period had delivered around 52% of return, while value was actually going through a pain period and it had delivered only around 13% kind of return. But if you see the next 3-year period from 2022 till the end of 2023, the factor actually went through a change. You can see quality had delivered around 130%, 140% of return. But on the other side, value had delivered almost around 90% more than that. It is 230% kind of return. So someone who stayed in the same factor, maybe he or she benefited during the first 3 years. In the next 3 years, they went through the pain. And that's the reason when you want to create a model, what you want less dominance of single factor. And that's the reason, as I said, we are using 5 different factors so that no single factor have a very, very dominant on the overall result, right? So we want to create a portfolio through the factors, which is not in a way relying only on single factor. It can be a style agnostic portfolio. So that's the reason we are using multi-factor, so that no single factor has over dominance onto the portfolio. Then you have a lot of macroeconomic indicators also. Like as I said, there is a lot of availability of data on each and everything which is there in the marketplace today, and that's the reason all this data can be used to get some kind of signals, and how you can optimize your model is something which we are trying to aim for, right? So if you see macroeconomic indicators also, like rising risk aversion, normally you find that quality is in favor, right? So when you see that interest rates scenario is favorable, you are seeing that interest rates are actually increasing. In that kind of period, you will see that normally one style does well when the risk reversion is on another side, the another style does well, right? So in a rising risk aversion, when everybody is trying to be slightly more conservative, the quality part of the market normally do well. And when everybody is into a risk on mode, in that period, normally you'll see that high vol or in a way value stock normally does very well. So in a way you can use these indicators also so that you can actually optimize your model. So let's say if you are in a rising risk aversion market, And normally, if you are into that cycle for a few months, then probably you gradually start giving negative weight to the top end of the curve. Same way, like let's say today, when you are into a risk on kind of environment, high vol names is actually something which you can give a negative weight. Actually, you can avoid that part of the market so that your portfolio can over a period of time give a much stable return experience to investor. Second and very important thing is that if you see Quant works very well when you are using that to eliminate, and when you are using that as a basket approach, right? So in a way, when you are using Quant as a factor to identify companies, you might say that this 20 names, this 30 names, this 14 names looks very interesting, rather than saying that this one name is the top name in the model and probably it can do very well, right? So it's works very well when you use Quant as a basket approach, and it actually works very well then when you use to eliminate, right? So I'm sure everybody when we meet normally ask this question that which are your best high conviction ideas, right? But it is actually very interesting that if you know what you don't want to buy, it makes your life much more easier, right? And specifically when you are into investment world, when you want to create a portfolio, what you don't want, if you have that clarity, then probably things becomes much more easier for you. So we use Quant as a elimination framework, and in lot of our funds, lot of our PMS strategies, we are using Quant as an elimination framework also. So along with that, what we are trying to do is that once you create a model, once you create the model, and you are trying to identify companies through that. Along with that, what we have done, we have used a fundamental insight also, right? So let's say this Quant model tries to identify companies, and the model is giving you this 50 names, which looks very interesting. But along with that, the fundamental insight is very, very important, and that's the reason this fund is not only relying on the Quant, but they also have a fundamental insight, a fund manager involved into it. Right. So basis this, we have launched a portfolio on a PMS platform, which is known as Quanti-FI strategy. So Quant is nothing but quantitative strategies which we are trying to use to identify companies. And then we are using the fundamental insight of a fund manager, which can do the combination. Actually, it's man plus machine, which can do very well over a long period of time. So what is the advantage of Quant approach? So first of all, as I said, we are covering around 600 companies. So when you define a framework and when you apply on the 600 companies, you actually can identify companies which can fit into your framework. And a lot of times what you'll see, the first advantage of Quant is that actually it's eliminate emotional biases, right? All of us have biases. Like let's say we would have gone through a pain of holding a company in the last cycle. And today, when we see same company doing well, we might not be very keen to enter into that name because the biases are there. Because in the last cycle, we would have gone through that pain that gives that biasness, and we might avoid a potential investment opportunity. Quant actually removes that. Second thing, the data or the availability and the scan which you can do on the number of companies is substantial, right? So when you want to identify companies, put the parameters in the system, you identify companies, and that will give you the universe. And it's more consistent and disciplined, right? So what model does, it actually brings a lot of discipline. It avoids the noise, it brings discipline. And they are very agile and very responsive, right? So that way, if a particular style is expected to go through a pain period, Quant is not style specific. So actually it can move from growth to value, value to growth, growth to quality, quality to growth. So that way the flexibility is much more, it's system driven and biasness are limited. Why fundamental overlay is very, very important? Because there can be a misinterpretation of the data by the systems. They are artificial intelligence, not a pure intelligence, which a human person can bring on the table. So that's the reason, to avoid any misinterpretation of the data, which is done by the model, you want to put a fundamental overlay onto it. A lot of time you have put so many parameters and trying to identify companies. There can be a case that a company which might not be very can be part of the portfolio is also coming into model, which can be avoided by the fund manager. So that's the reason we believe, as I said, Quant alone might not do so well. Fund manager alone might not capture many ideas, and that's the reason combination of both can play a very important role for investors over a long period of time, and that's the reason we believe that fundamental overlay is required, and that's the reason Quanti-FI is trying to have combination of both. The aim of this model is to identify companies based on Quant model, and we'll discuss what parameters we are trying to use in this and how we are trying to use this. We use fundamental and other factors to identify companies. Internally, we are covering around 600 companies today. So what we do normally, we try to eliminate companies which don't have a more than 3 years of track record. Then we apply the filters and try to see how many companies are fitting into that framework. And over and above that, once you get 50 companies from this 585 companies of universe, the best 40 ideas out of these 50 ideas eventually will come into the portfolio. So let's say after doing the discussion within the team, the best 40 ideas eventually come into the portfolio. So how this model works, right? So first we are trying to avoid companies which are very volatile. So the first parameter is low price volatility. So we are looking for companies where the volatility in the stock price is lower. Now, when I say we are looking for that company, we are trying to eliminate companies which are very volatile. So that the Quant is used to eliminate companies. So high volatile names, the bottom quartile is getting removed after this first filtration. Second is high on quality, and it's very, very important parameter, specifically in the current market scenario where you are finding a lot of non-quality companies also doing extremely well, right? So you want to avoid names where the quality is inferior, right? So you are again removing the bottom quartile where the quality is not so great. The third is valuation and reasonable on valuation. So again, we are trying to remove the expensive name from this universe, right? So bottom quartile, the names which are very expensive compared to their own history and compared to the entire universe, those set of companies are getting removed. The fourth is sequential earning growth. So companies where the earning growth number is not improving, those set of companies actually go out after this filtration. So we are eliminating the bottom quartile after this filter. Again, in this, what we are using, we are not only using the earning growth rate number, but we are also trying to put what kind of volatility you have in this earning number. So if your earning growth is very strong, let's say if a company's earning growth is very strong, but the volatility in the earning is also very high, then probably they will score low. If your earning growth is also strong and your volatility in the earning is also low, then probably you'll score very high. So companies where the earning growth is not there, companies where the earnings are more volatile, they are actually getting eliminated after this filtration. The last filter is price performance, how the stock price have behaved in last few months, few quarters. That is what we are trying to evaluate after this filtration, because the first four filter, if you see, are based on data, fundamental data, and they are backward looking. I would say price performance is forward looking indicator, because a lot of time what we see that if the company's earning numbers are expected to remain very strong, they might see the analyst or the sell side analyst normally upgrades the number for them, and that's the reason the stock also react to them positively. And that's the reason we believe this parameter, the last parameter, is actually more forward looking. And that's the reason combination of 4 parameters which are backward looking, 1 parameter which is forward looking, actually had given a very favorable result when we had done back testing of this model over last 20-year period. And we believe from here on also this factors can do very well in terms of return over a period of time. So how the portfolio looks like, and broadly this portfolio was started in Feb 2024, so we have got more than 7 months of track record now. If you see, the portfolio has got around 50% of large cap and 50% of mid and small cap. Broadly, if you see the split of the portfolio, around 30% is into manufacturing. Manufacturing allied put together is around 45%. Almost 25% is into financial services. Healthcare IT put together is approximately around 17-18%, and rest of the basket, which is consumption oriented and services oriented names, are approximately 10% of the portfolio. So if you check our view from a fundamental investment point of view, is also on the same line. We like manufacturing allied, we like financial services, but in a way we are very, very bottom up, and this model The Quant-based model actually is very, very bottom-up, trying to scan all 600 companies which we have in the universe, trying to identify companies where the business management valuation framework is fitting, and trying to create portfolio out of that. So that way, this portfolio is created. Moving on, few of the ideas actually which had been into the portfolio, how they have done in last 6-7 months. Like the first one is a mid-sized oil oil refinery company. This company actually is into an expansion mode, where the capacity for them is moving from 3 million metric ton to 9 million metric ton over the next few years. They are one of the fastest growing hydrocarbon producer globally. For them, the gas production capacity is also going to double in next few years. So that way, this name from fundamental point of view was looking very strong to us. And it came in the model. Fundamental view was also positive. That name came into the portfolio. You can see in the Feb 2024 is when we bought this name, and that's the reason that dotted line is there in the graph. You can see after we bought this name, we made sizable amount of return in this name. We have tried to avoid the names of the companies. Reason being, names are not so important here. The model or the factor which is trying to identify this company is very, very important, and that's the reason we want to. Actually, ideas or the stock are not so important in this kind of framework. Actually, how they are identified and how they have done over a period of time is very, very important. The second is one of the leading battery manufacturing company in the country. In a very duopolistic kind of market, there are two players. It's one of them providing a battery to auto OEMs. It is providing battery in aftermarkets also. It is used in auto and even industrial space also it is used. So that way, this is one of the leading name into the battery space. They signed, actually we bought this name in 2024 because of the framework. What I said, the valuations were very attractive, one of the leading player in the battery space. But after we bought, they were able to get, they actually had done technical licensing agreement with one of the leading player in the global market, and that after that they were able to enter in the lithium-ion cell space also, and probably they can be beneficiary of the EV adoption which is happening both in domestic market and the global market. Again, you can see when we bought, it went through a consolidation phase, and post which the name did very well. Few of the names which are in a way have contributed, but not like the previous one. The first one is one of the leading fertilizer companies in the country, and in a way they are very, very efficient, backward integrated. Obviously, in fertilizer space, if you see the volume growth have been into single digit, and that's the reason this company, which is generating very high free cash flow, is trying to deploy the free cash flow into the allied businesses, right? So they are actually in a way trying to find a lot of other revenue stream, diversifying from the fertilizing business. They are entering into specialty chemicals, CDMO business, drones. So that way they are trying to actually diversify the revenue stream. Again, we bought in month of Feb this name. You can see it went through consolidation till a few months, and post which again the factor actually played out well, and the stock actually created alpha of almost 20% since we bought. The last name again is from IT services space, one of the leading process management company and data analytics. Again, this name was very attractive in terms of valuation. It was available at a very, very attractive valuation compared to the market and compared to the sector. Again, it was a name which was trying to focus. The company actually was focusing a lot on margins. There was a change in leadership, and post which what we saw, they started focusing on the top line. They actually started focusing more on growth, and we believe over the next few years this name can actually benefit by a very big margin, and that's the reason this name also came into the portfolio. So the point is, once we get the output of the model, and the entire investment team of this 5 fund manager, including Anand Shah, discuss what is best 40 names, which are the best 40 names out of this 40, and eventually those names comes into the portfolio. Again, in terms of, and we believe this data point is very, very important for someone who is evaluating the portfolio for investment, because what you have in the portfolio, what you get is output, but what is the in terms of profit growth rate. You can see the names which we have in this portfolio, their profit growth rate is higher than the benchmark profit growth rate in last 3-year period. Their ROE profile is improving, where the number has actually gone from 15.8 to 21. And along with that, if you see valuation, again, compared to market, where the number is between 23 to 25, the PE multiple of this portfolio is around 20. Even in terms of price to book value, because earnings are more volatile, even in terms of price to book value, the valuations are reasonable compared to market. So again, what we are looking for is actually visible in this data also, that you want companies where the growth is strong, where the quality or ROE is improving, and along with that, where you are finding reasonable valuation. So that way, the portfolio is actually trying to give you that kind of ideas into the portfolio. How the portfolio construction happened, and I think this is very interesting because it's a PMS structure that gives flexibility. So what we do, actually, we scan the market based on these factors every month. So every month we try to scan 600 companies based on these factors, and we try to see where we are finding the ideas. And the 50 ideas are thrown from this model. So 585 gradually come down to 50. This 50 ideas come to the fund management team. The fund management team sits on these 50 ideas and try to evaluate name by name, idea by idea, sector by sector, that which are the best 40 names from these 50 names. Again, these 40 names are going to be the part of the portfolio. And again, because this 40 names are coming after many elimination, and that's the reason these 40 names are in a way the best 40 ideas of the model. And that's the reason we don't want to take too much of in a way weight call on this 40 names. So we are creating a 2.5% equal weight portfolio of 40 stocks. So aim is to keep this number at 40, but the number can be 35 also, the number can be 45 also, depending upon how many ideas are looking very interesting from that model. As of now, we are creating 40 stocks portfolio, 2.5% each, but the number can go to 35 also if the ideas are limited. The number can go to 45 also if the ideas are many. But what we have seen many times that the ideas are different in few portfolios, but the output might be very same. And that's where the factors are playing very, very important role. So that way, we are trying to create monthly portfolios every month, and we are aiming to rebalance or review the portfolio at the end of quarter through the model. And in between, if the change is happening because of fundamental reason, we will actually do the changes whenever it is required, right? So the discretion is at the end of fund manager. If they believe that there is a big change from a fundamental point of view in the company, then probably we might do the changes in between also. But ideally, the review and rebalancing review happens on actually daily basis and monthly basis, but the rebalancing normally will happen at the end of quarter, and major changes will happen at the end of year, so that the tax implication of the portfolio can remain on the lower side. But again, it's more at the end of discretion. If we believe that there is no point of waiting in the name for a longer period of time, in that case, we might actually cut down the exposure in between also if the view is not very strong. Moving on, how we are trying to manage risk. And again, it's a model driven, and many times we have a worry that how the model will play out over a longer period of time. And that's the reason at first step, what we have done, we have tried to add an individual layer, a fund manager layer to it, so that anything which is not worthy enough to come into the portfolio, that can be eliminated by the fund manager. Second thing, the model is based on multi-factor, right? So it is not trying to have single factor dominance. So it will avoid the style biases over a long period of time. The aim is to rebalance the portfolio at periodic intervals. So any idea which is playing out and the risk reward ratio is no longer favorable, those ideas might go out of the portfolio. And because we are running or scanning the market every month, the fresh ideas actually can come into the portfolio. But we are aiming to keep the portfolio churn or turnover on the lower side. That's the reason we are creating monthly portfolios every month. In terms of sectoral limits, the fund can have either 20% in a single sector or benchmark weight plus 10% kind of exposure. So whichever is higher is the max limit which we can have into the fund. How the fund has performed in last few months. As I said, we started in month of Feb 2024. The portfolio had seen volatile phases. So we saw election in between. We saw a budget in between. The portfolio has done reasonably well, and the month of August had been also decent. So hopefully the numbers, once updated for August, the numbers can look even better. So that way, again, as I said, the performance is output, which is not in our control. What is in our control is how we are trying to create the portfolio, and someone who is evaluating the portfolio today, for them, rather than seeing the performance number, this data point is more important. That when you create a portfolio based on factors and based on individual fund managers' involvement, what you are trying to get, right? You are trying to get companies where the growth is more stronger, where the quality or ROE profile is improving, and along with that, where the valuations are also reasonable compared to the market. So I think this data point should give more comfort to investors that from a next 5-year perspective, the portfolio is reasonably well positioned, and the portfolio will not remain static. Portfolio will change over a period of time depending upon how the markets are moving, how the sectoral positioning is moving. And as I said, the model is actually trying to scan the market on a monthly basis. So any idea which looks more interesting compared to the current portfolio, those ideas can be introduced into the portfolio, so that from next few years perspective, the portfolio is very well positioned. So I'll pause, Kamal, here, and thanks again for having us on this call. Happy to answer any queries, any questions if you get on the chat box.
Sure, Sandip. I'll just maybe stop the screen share. I think this was very detailed, and you have left no scope for any questions. But otherwise, in general, it is like pertinent to understand. I had asked this question, over the chat. Do you believe quant plus fund manager can beat passion and experience which come with non-quant based fund management? We today are kind of in an economy which has not seen growth beyond, say, 4 trillion, right? So from 4 to 8 trillion, when we'll go, it will be absolutely a new territory. Over last, say, 2-3 years, we saw equity market actually going down to 25,000 levels during COVID and coming up now to 80,000 levels. And obviously, it had some pattern, and hence it moved out of growth, went into value. And then, we have seen kind of, value sectors like, I would say industrials, manufacturing, all real estate, all the sectors which had not participated, like PSUs, railways. These are value sectors, they participated. And there was a pattern that, yes, in 2000 and in the first decade of the century, value style of sectors like infrastructure and all had done really well. And then in second decade, growth sectors had done well. And now when markets fell down and worldwide interest rates also went up, that led to, it was easy to understand, yes, now markets are going, and hence quant maybe was unbiased and was able to catch hold of this changing trend very fast. And that is where over last 1.5-2 years, quant funds have done well. And that has led to mushrooming of a lot of quant funds. But now from here onwards, it's like new future, new trajectory from 4 to say 5 to 6 trillion, whereby obviously, one has to actually identify which are the businesses which are ultimately going to eventually compound over time. How will quant, ultimately understand the passion of I would say a promoter or a passion of a, entrepreneur without meeting, them, without doing a legwork? Because we, as advisors or investors, if I put myself in investors' shoe, when we will, cut a check of 50 lakhs and give it to a quant-based fund, this preconceived notion will be there that quant fund managers are doing, the entire thing based on systems sitting inside the office. They may not be aware of what is happening on the ground, right? That's the fundamental question. If this fundamental question is addressed, from there onwards, a lot of, I would say, serious investor minds will actually start to seriously think about quant.
No, so you're correct in a way that if you are actually running the models and trying to create a portfolio, there is a chance of error. And because of that, what we have done, we have tried to do combination of both quant plus fundamentals. But what we have tried to do that the output of the quant will be the primary source of the portfolio creation. So when we bring down that number from 600 to 50, the role of the investment team is to bring down that number to 40 by eliminating 10 businesses, or I would say selecting the best 40 ideas from the 50 names. So that way the judgment or I would say the involvement of the fund manager or individual is very much, at least in our quant based framework, when we are trying to create the portfolio, at least at that table we are trying to use the expertise of the individual fund manager. But why the models are very, very useful, and we believe that over a long period of time the quant is going to become a primary source of decision making. The reason is that number of companies, if you see, which are actually creating or actually contributing to the PAT growth rate number have increased substantially. I'm sure if you remember, we had one slide in our presentation where the previous 5-year period was when only one part of the market was doing well, which was consumption. And manufacturing allied was going through a tough time in that 5-year period. But post 2019, both part of the market have started doing very well. And that's the reason the number of companies which are contributing to the PAT growth rate number have increased. So the point is the number of ideas which are present today, which can become part of the portfolio are many. And that's the reason you have to create a framework so that you are eliminating companies which you don't want, but the companies which are worthy enough can be there to in a way you can focus on those names which can become part of the portfolio. So that way the number or the breadth of the market is also increasing. That's where you can actually use model to identify company. Second thing, if you remember till 2019, 2020, because manufacturing allied had gone through a very, very tough time, a lot of individuals or I would say a lot of members in the fund management team were actually not very comfortable to own those businesses because they had a very, very tough time. So that's where the emotional biases which were there of the individuals were playing a role. But when you run the model and when you get more ideas from that basket, that can be utilized. I'm sure 2 years down the line, 3 years down the line, if this kind of trend continues, you will find a lot of individuals might not be very comfortable to own consumption part of the market because manufacturing allied would have done so well. Probably they might not be comfortable owning consumption part of the market. And I'm sure at that point in time, the model will give you a lot of names which are from that part of the market. I'm sure you would remember that between 2005, 6, 7 was a period when infrastructure was doing very well and everybody avoided defensive names, and post which we saw defensive did very well. So the point is these models can be run to avoid the emotions which are there of the individuals, and probably the combination of the model and the fund manager can give the output which is desired by you as an advisor or as an investor, that it is not only systems which are running, but you have an individual, or at least at our end, ICICI Prudential AMC's entire investment team is involved, that the best 40 ideas will eventually come into even a quant-driven portfolio.
Sure, Sandip. So, recently in the budget, the short-term capital gain tax has gone up from 50 to 20%. And when you say that you do resetting of portfolio every month based on, quant, to keep it unbiased, which is like, good check from your end, it also leads to more churning and eventually, a lot of, I would say, expense goes towards paying short-term capital gain tax. And then, net of taxes and net of expenses, how will you actually beat some of the, I would say, better performing funds, mutual funds or PMSs? Is another question that, I can see people are wanting to ask.
So thanks for this question. Actually, we are creating portfolios every month. So let's say someone who came in month of February 2024, they had that 40 stocks in their portfolio. We ran the model in month of March. We saw almost 32 names were common, 8 names were different. For investors who came in month of March, for them those 40 names came into the portfolio. But the investor who came in month of Feb, their portfolio remained as it is. So that way, actually, we are using monthly portfolios or quarterly portfolios to reduce the turnover, reduce the churn. So for Fab portfolio, the major changes will happen in month of March 2025. So we'll complete 1 year. Major changes will happen at the end of 1 year so that we don't pay too much of short-term capital gain taxes. While this will ensure that you hold companies for a longer period of time, but in between, if there is a change which is required because of fundamental reasons or because any better idea which is coming into the portfolio, those minor changes will do in between. But otherwise, major changes of the portfolio will happen at the end of 1 year. The March investor, for them, the reviewer, the major rebalancing will happen at the end of April 2025. So the monthly portfolios are actually trying to ensure that the tax implication for the investor is actually lower. We also understand as a investment manager that if you churn the portfolio many times, the post-tax return might not be so great for the investors. And actually, to reduce the impact of that, we have tried to create this portfolio construction approach, because of which we believe it actually can bridge the gap which is there between the pre-tax return and post-tax return.
So what is your quant model suggesting now at these levels where markets are high? Like, there is a lot of I would say talk going on amongst investors, advisors, that yes, small caps are very expensive, so maybe keep small caps aside. Any new incremental investments you want to do that in large caps. Within large caps also keep maybe PSUs aside, only invest in quality names. If one has to select between SBI, HDFC Bank, invest in HDFC Bank. And we know, obviously, HDFC Bank has not participated. And likewise, I'm just giving an example, not that particular stock, is what is relevant in this conversation. But what is your quant saying at these levels for way forward, for markets? And are you kind of, applying that accordingly in your construction of the portfolio?
Yeah, so definitely we are applying. So let's say if you see our portfolios have good amount of allocation into defensive part of the market also, like we had a good amount of allocation into IT pharma pack, we had good amount of allocation into consumption names. So that way, that part of the market is also there in the portfolio, which is perceived to be less volatile. Now we have to see whether that plays out over the next few years or not, but it's perceived to be less volatile. That part of the market is there in the portfolio. Second thing, it's a product which is trying to be a fully invested equity portfolio. When you want to create a fully invested equity portfolio at this market juncture, which is where the valuations are neither very expensive, but neither very cheap also, we are into that zone where you have to actually focus more on companies which you have in the portfolio. And that's the reason the model actually is trying to identify companies where the valuation is not very expensive, the growth is reasonable, where the quality is improving, the volatility of the portfolio or the stock is less. Those kind of names we are trying to have in the portfolio. So I'm sure if you remember, the PAT growth rate of the portfolio was higher than the benchmark in last 3-year period. ROE profile was improving, and along with that, the valuation compared to the markets were reasonable. But it is a fully invested equity portfolio, so that way it is trying to identify companies where you get combination of all these three.
So we have seen, there was an era where a lot of money moved to, so-called quality names. People were ignorant of valuations, and we kind of heard those businesses as moated businesses, ever compounding businesses, or consistent compounding businesses like Asian Paints and likewise Bajaj Finance, HDFC Bank. Is your quant also conveying that the times of those businesses is again coming, given the overall, I would say, dynamics of equity markets? Or your portfolio is like not only kind of seeing market as entering into quality zone, and your model is cognizant of valuations also, and your portfolio still would have maybe PSUs, railways, manufacturing, industrials, which are like not seen as quality, or maybe are B2G businesses also?
Okay. So today, if you see, we don't have too many railway-based PSU in the portfolio. We actually don't have any. We don't have any defense names also into the portfolio, at least at this point in time. And what we are trying to do, actually, valuation is one of the very important criteria in this model. And if you see, the value was much more in terms of preference rather than growth at this point in time, because the way markets are moving, obviously, finding ideas where the relative valuation is reasonable is becoming more and more difficult. That's the reason the valuation is on the higher side. The value factor is on the higher in terms of order. Again, do we have a style bias in this portfolio? The answer to that is no, because we are using multi-factors today. So a lot of companies today we are having is actually combination of growth, improving ROE profile, and reasonable valuation. So today also we are not getting too many names which were erstwhile considered to be the quality part of the market, but they have gone through pain period. So even today we don't have too many names from that basket at this point in time. But we had done actually backtesting of this model till we went up to almost year 2002, almost 22 years of backtesting which we had done. Interestingly, in March 2008, when market was at peak, it was actually throwing up a lot of defensive names into the portfolio. So pharma, FMCG, to an extent IT was the top three sectors at that point in time. Same way in March 2020, it's very recent, so we remember banks were much lower in the model output, and pharma and IT and consumption was very high. So that gives a lot of comfort that during the tough periods of the market in past, in hindsight, obviously the portfolio was actually able to throw decent output that gives a lot of comfort, and that was the reason of launching this portfolio for the investors.
In your presentation, you mentioned that after doing filtering and coming to the short list of stocks, you will give them equal weights.
Right.
Why would your quant not give I would say high conviction, high weights to some of the I would say sectors where quant is more convinced? Because weights also, allocations and weights also play a significant role in generating alpha. Because at the end of the day, you have to beat the benchmark. That is what investors will look for when they're giving money to a PMS.
Right. So what we have seen, or what we observed when we did backtesting of last 22 years, the basket approach had actually done very well. And globally also, if you see a lot of quant-based funds which have been very successful, actually run a basket approach. So rather than actually playing on the weights, we are actually trying to have factor as the hero of the performance over a long period of time, right? So that's the reason. We are trying to have equal weight portfolio. In backtesting also, the results were great. We try to evaluate a lot of funds which are successful globally, how they are also managed, and we found that equal weight is in a way appropriate approach to have when you are trying to create a quant portfolio. But again, every model will go through optimization phase. In case if over a period of time we believe playing through weights can help us, then probably we might introduce the change in the weights also over a period of time. But at this point in time, we are very comfortable having equal weight 40 stocks portfolio, or it can be 35 also, it can be 45 also, depending upon how the outputs are. But aim is to keep the number around 40 at this point in time.
Sure, I think Sandip, more or less, we are done with all the questions. One last bit of thing, your strategies which are currently running, which have longer track record, like Contra, Pipe, Value, which have like more than 5 years of track record, have done really well, and they have throughout delivered alpha. So were they also using quant? Because you said that you have a full-fledged team, and now obviously you showed the name of all the fund managers, which is headed by Anand Shah. But the historical returns that we have seen in various PMSs where assets have also grown and there is a massive alpha, were they also using some kind of quant, or you are using quant now for the first time in these new quant focused AIFs and strategies that you have created?
So actually we started using quant in one of our PMSs called Smart Strategy. It is actively managed PMS portfolio. We started using quant in that portfolio around a year back for elimination. So as I said, we like quant as a factor which is very helpful in eliminating company. So we started using quant in that portfolio, which is actively managed. Chokalingam, my colleague, is the portfolio manager for that, and the output of that PMS is excellent. So outperformance over last 1 year period had been excess of 15%, and obviously it gave a lot of comfort that now we can launch a portfolio which is based on quant side. So a year back we started using to eliminate, but the output of the model itself was very strong, and that was the reason we came out and launched a portfolio which is based on quant. So we are using this quant in other portfolios also. For, as I said, but for a lot of funds, it's a guiding factor. For Quanti-FI, it's a deciding factor. So model is used for a lot of funds, but for a lot of fund, it is a guiding factor. Whether they want to take action on that idea or not is up to the fund manager. But for Quant, obviously, it's a deciding factor. So that way, the model is used across portfolios.
Sure. So, for a few of the viewers, the ticket size in PMS is 50 lakhs and in AIF it is 1 crore, because I see some of these questions also asked. Anything else that you think, you want to answer, Sandip? Maybe in the chat box, you can have a look and you can answer, reply. Otherwise, we'll kind of conclude the session.
Sorry, but I'm not able to see the chat box icon here.
Okay, no worries. I think we have more or less covered all the questions. I have kind of glanced through. I don't think there's any question which is not answered yet. Do you use hedging to generate alpha over benchmark in your AIF?
So this portfolio is on PMS platform. In PMS, we are not using derivative strategies. So that way, it is pure, fully invested equity portfolio. We are not using hedging tools in this portfolio.
Perfect. Thank you so much for your time, Sandip. I think it was a pleasure conversing with you. It was the first conversation, but I think it was very, very enlightening, and wish you all the best for your fund management career. And this fund will kind of look forward to this creating, I would say, longer track record. It's like in almost 6 months, it's the 19%, which is like quite decent. But let's give it some more time. And at the same time, interacting with you has been really kind of our pleasure. Our platform promotes some of these differentiated strategies, as I introduced you in the beginning. And thank you, everyone, for kind of joining us today. If you guys, anybody wants to do any conversation with any of our specialists for this particular product or any other product, you can come to our platform, PMSAF World, book appointment with us. We are more than eager and happy to connect with you to help you for alpha-focused investments. Most of the AIFs are created for alpha, and this is also a product which is created by ICICI for alpha. And every strategy is like different with different benchmark, and how alpha is delivered and kind of, I would say, aspired by each fund manager is something that we understand very well. Not just how fund managers convey in their brochures, but how we read it through our own analysis and statistics. Hence, I am kind of asking if any one of you is keen to know more about any of these products. You're most welcome to connect with us. Thank you once again. Thank you, Sandip, for this.
Thanks, Kamal. Thank you for having us on this platform. Thank you, everyone, for joining the call. Thanks.